shock from U.S. tariffs on China significantly higher than 2018-19, Morgan Stanley informed. The Trump administration announced an additional 34% increase in tariffs on Chinese goods, adding to the 20% increases realized in February and March. With this latest move, the weighted average tariff rate the U.S. imposes on China has reached 65%, making it one of the highest in the world. The tariff shock from the U.S. will be significantly higher and more comprehensive than in 2018-2019, Morgan Stanley strategists led by Robin Singh said in a research note. In addition to a direct tariff shock to China's exports to the U.S., the indirect impact would also be notable, as widespread U.S. tariff increases on other trading partners would slow global trade, they explained. Current tariff levels are not just economic tools, but are also linked to strategic goals aimed at protecting sensitive industries and boosting domestic investment and manufacturing in the U.S. This means that the bar for negotiating and reducing tariffs has gotten much higher, the strategists added. They believe any policy concessions from China may not be enough to soften tariff levels, as U.S. objectives go beyond immediate economic concerns. In anticipation of the negative effects of the tariff shock, Beijing is expected to accelerate the rollout of the 2 trillion yuan stimulus package announced during the National People's Congress. However, Morgan Stanley suggests that even with potential additional policy support, such as national birth support and expanded consumer goods exchange programs, these measures may only partially mitigate the impact of tariffs. As a result, the firm sees a downside risk to its baseline GDP forecast for China for 2025, which now stands at 4.5%.